You're on radio. Many people, this is home.
Radio Cayman in the Cayman Islands.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
To keep our records up to date and to ensure seamless communication, the Cayman Islands Chamber of Commerce Pension Plan encourages you to review and update your beneficiaries and contact details, including your email and mailing addresses. You can update your contact information by logging into the member portal or by contacting us at 745-7630 or via email to admin@pensions.ky. Remember to act now to ensure we have the most current information for you. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to the first show of 2024. I'm Simon Caudry and I'm delighted to be joined by both Adam Butler and Emil Kalinowski. Good morning to you, gentlemen.
Thanks for having us.
A pleasure. Happy New Year.
Happy New Year to you, yes. Now, with these two fine specimens of human knowledge joining me, we are going to have a great discussion on what happened in 2023 and what we can predict and perhaps not predict about 2024. So good morning once again, and are your thinking caps and wisdom hats firmly affixed?
My wisdom teeth never fell out, but I didn't bring a hat. I feel that's halfway to what you're asking.
And then halfway is a start. That's
I can't wait.
So let me kick off this conversation with a postulation. I can currently earn 5% by buying a money market fund or a 6-month US Treasury bill. Why should I take any risk in investing my money for the next 2 quarters?
Well, there seems to be a market movement towards concern about recession in the United States and globally. There seems to be one taking place already in Europe, and China seems to be struggling. So there seems to be risk in the world economy. Therefore, rates will be falling. Therefore, you're suggesting stay in the 5%. Is that what you're saying?
Yes, because I can buy 6 months paper for 5%.
For the returns in equities, commodities, currencies, stock market, what else? And crypto.
Why take any risk when I can earn 5%?
Well, I suppose I'm in agreement with you there. Yes, it seems safer in long-term government bonds for the next couple of quarters. Adam, what do you think?
Well, I think there's a big difference between 6-month paper and long-term government bonds, right? So let's peel that onion first.
Before we start, our eyes are going to start watering as we go through this metaphor.
Yeah, that's right. I mean, look, the rates markets are currently discounting a huge amount of Fed easing in 2024. I think the implied SOFR rates, so the implied forward effectively Fed funds rate for June is about 200 basis points below here. And there's a 10% probability implied by the rates markets of a 400 basis point cut by the end of December 2024. So, if you're looking at short rates, the interest rate markets are telling you that when you roll that 6-month paper in 6 months' time, you're going to be rolling into paper that's about a 3% interest rate. And there's a 10% chance come December, you'll be rolling it again into 1 or 2% interest rate, right?
So it looks good for a short period of time, but then it gets nasty quite quickly.
Well,
for me as an investor in that sense.
Yeah. Now, to be fair, if we go back to the beginning of 2022, economists in January of 2022 were looking for a 325 basis point Fed raises over the course of 2022, and instead we got going on 10, right? So it's not like the forward markets are particularly good at forecasting what's coming down the pike, But certainly if you want to go by what the average of market participants are telling you, then taking some risk may be warranted, because just sitting in short-term cash may not provide you the long-term yield that you require in order to meet financial goals.
But then if the forward markets are right, so if they are forecasting and saying it's going to be 2, 3, 4 percentage points lower in 6 and 12 months' time, that implies that there's a very easy way of making quite a lot of money, which is by buying medium to longer dated bonds, potentially government bonds. Because if interest rates do fall, prices of bonds go up, that standard equation, which means you can make quite a lot of money. Now, I know that the yield on a 10-year is around about 4% versus the yield on a money market, which is 5 and a bit percent. So there is a bit of compression that needs to happen, but you're saying the futures market is saying 2%, which is much more than the current difference, which means you could make quite a decent capital return by buying a longer dated government bond. So that seems almost too easy, doesn't it?
Well, I mean, first of all, let's reinforce that mechanically, right, the way that bonds work, when rates fall, the price of the bond rises, right? So that's how you get a capital appreciation on your bond investment, right? So to Emil's point, I'd love for him to flesh out his case for why an investment in the long bond might be a good bet coming into 2024. But if indeed we do see a drop in long rates, then obviously investing in the longest duration fixed income investments possible gives you the biggest bang for your buck, right? So, what's your thesis on why long rates may be a really nice bet here?
Thesis.
Well, the thesis would be that we're moving towards an unsettled future more than usual. And these sort of investments, the long-term bonds, gold, utilities, other such things that you can count on, would be demanded by the great investing public around the world. And why would we be heading into an uncertain future? I think the best example would be the United States election. You have someone who's addled versus indicted. That seems a poor choice. The Europeans have their parliamentary elections. There's more uncertainty there, more radicals, more outsiders that we can expect there. Chinese economy in the United States, the confrontation continues with trade wars and geopolitical confrontations, wars. There's also been a lot of talk about aliens lately. So,
where has there been talk about aliens? What books have you been reading?
These are the off-brand news sites, not CNN.
I see. Right.
Mr. Consensus and mainstream media, Simon over there. So it seems unsettled. The general, as I've been talking on this show for many, many years, we're in an uncertain era. We're at an inflection point in world history when one era is ending. Economically speaking, we seem to be ending the Margaret Thatcher, Ronald Reagan laissez-faire era, moving towards a government more what we had after the Second World War, the dirigiste sort of government involvement in the economy.
You just want to practice your French, don't you, dirigiste?
I can't believe we always look askance at the French, and yet they have these two very important economic terms that are so critical to how the world is ordered.
Red wine.
So, I could go on, but I've made that point before. We seem to be exiting one world order, entering a new one. And as we're making that move, it's in these sort of periods where there's so much volatility.
Well, I want to come back to Adam's observation about the futures market, because it sort of circles this conversation slightly. You mentioned that the futures market has this percentage expectation that we could be at 1% by the end of this year. If we flesh out what that means, or not what it means, why that would happen, the only plausible circumstance under which that happens is the US economy is in a absolute horrific nosedive. There's no reason otherwise to cut interest rates as aggressively as that and take them back to what were supposed to be exceptional circumstances. I think we should remember when zero interest rate regime was introduced, it was called exceptional for a reason, which is it was unique. It had never happened, and 4 or 5% interest rates were the standard operating procedure for global economies in times of normality. So if there is a chance, and that chance arises, that we get to these exceptional circumstances, something exceptional has happened, whether it be a global issue, a geopolitical issue, or whether it be an economics issue. So in that sort of circumstance, if the futures market has this level of pessimism or this anxiety about the future, doesn't it play even more to say, well, just keep your money as safe as possible. Don't go and be speculative and invest in these wild and fanciful things called equities. Invest in the safest thing you can find, the US government treasury. Because even though the US government treasury may not pay its debts, they still always honour their debts, even if they may not pay them, oddly. But to talk me through that analysis.
Well, over the last 4 decades, we've seen with maybe the exception of the last couple of years, we had a very clear pattern, which was when there was economic weakness, there was no inflation really before, like even when the economy was strong, inflation was tame. And so when growth slowed, the Fed and the Treasury could step in very aggressively to lower rates and increase the fiscal impulse. In other words, take on budget deficits to inject money into the economy in order to add a stimulative effect both to the economy and financial markets. We saw over the last couple of years is that, and there's all kinds of speculation on why we saw the surge in inflation that we saw, and there's probably lots of discussion that Emil and I can have about whether it really qualifies as inflation. But certainly we saw a major increase in the price level. And what that did was it constrained the Fed in a way that it hasn't been constrained really in 40 years. Now it's fighting a battle on 2 fronts. We've got to manage the business cycle risk, which the Fed has been able to do in a very unconstrained way for the last 4 decades. But now we also need to battle inflation impulses because of onshoring, because of a major fiscal impulse during the pandemic, and of course, the total lockup in global trade and supply chains that happened during the pandemic, right? Obviously, we've had a major easing in supply chains. The Fed has been allowed to run off its balance sheet, so-called quantitative tightening, and it hasn't really had any impact on growth expectations. Like growth expectations are still pretty strong, and I think people are signaling that they think we're going to go back to this same environment we had over the past 40 years, low inflation, reasonably strong growth, and that's why we've got stocks near record high valuations. At the same time, we've got the market discounting interest rates going back much lower, right? They're signaling we can have growth without inflation, which will allow the Fed to reduce its interest rates, right? So, that remains to be seen. That would be very favorable for equity prices and for bond prices. The big question mark is whether inflation does in fact go back to where we are used to seeing it.
And we will definitely touch on inflation. We've got about 40 seconds before we take our halftime break. But one of the things that is lingering in my mind, I read a very interesting article, I think it might have been this morning or yesterday on Bloomberg, where the author was talking about the risks of a Middle East further conflagration, whereby you have 2 principal shipping corridors in the US, in the world. You have the Panama and you have the Suez Canal. And there's a very easy pathway to the Suez Canal getting blocked up and inaccessible. Or the prevention of that is a pretty nasty fight. And neither of those would be good for price levels because it would cause shipping costs to go up. It would cause various other knock-on effects. And that would have, back to your point, another rising level of prices. Whether that's inflation or just a one-off increase in the price level is a different question. But again, that would spook the Fed because the Fed can't envision a world where it accepts 5, 6, 7% inflation. It's just not permitted to. And so perhaps when we come back from the break, we can discuss what that might mean. Because again, it plays into this scenario in my mind, which is, I'm not saying this is my view, but it's a scenario whereby if you know you can earn fairly decent returns, almost regardless of what happens in the world from a bond investment perspective. So if there is inflation and you've locked in some fixed interest, fine. If there is inflation, interest rates don't go down, fine, you're okay in bonds, but equities get harmed. What are the scenarios? I guess the question I want to leave you with to think of is, what is the scenario whereby equities would outperform a fixed income portfolio over the course of this next 12 months? So let's take a quick break and discuss that straight afterwards.
To keep our records up to date and to ensure seamless communication, the Cayman Islands Chamber of Commerce Pension Plan encourages you to review and update your beneficiaries and contact details, including your email and mailing addresses. You can update your contact information by logging into the member portal or by contacting us at 745-7630 or via email to admin@pensions.ky. Remember to act now to ensure we have the most current information for you. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense with Emil Kalinowski and Adam Butler. We are whirring through various topics germane to 2023 and 2024, so let us not dilly-dally. Let us get right back on the horse and have Adam expand on possibilities as to why equities may perform or have the opportunity to perform, or not.
Yeah, I mean, I think it's useful to set some historical context. And a lot of the disinflation that we've seen, so a reduction in the rate of inflation that we've seen over the last 6-8 months, is explained by considerably lower energy prices. We had a major bear market in natural gas and another bear market in oil and gasoline, and that just has a disproportionate impact on aggregate price levels, especially the prices of goods, right? In the 1970s, which was really the last time we saw a major surge in the price level. It was triggered by a couple of conflagrations in the Middle East, right? One where Saudi Arabia first began to exert their influence as part of what eventually became OPEC and shut off the shipping of oil and distillates to the U.S. And I mean, many older people will recall lining up for gas at gas stations and a huge inflation impulse. And of course, the removal of the Shah of Iran. And that obviously had a major impact as well, because Iran is a major exporter of gasoline and other processed refined fuels. So here we have another conflagration in the Middle East. So far, OPEC hasn't really become involved, and the context now is a little bit different. I mean, we were on the verge of a historic peace deal between Saudi Arabia and Israel prior to the very, unfortunate events that unfolded. And but now you've got Hamas making noises about the fact that they're very upset that Israel targeted one of the primary leaders with some major targeted attack. And so Hamas is making noises about getting involved. Hamas is very clearly Iran. A proxy of Iran's. So, the potential here, I think, for a major conflagration in the Middle East is a lot higher than is maybe being currently priced in the oil market. If we get a major surge in oil prices, then that would be deleterious to the inflation picture and harmful to both bonds and stocks.
Perhaps a longer term perspective or view rather on this, so I agree with you that there's a lot of things that can go wrong in the Middle East which could harm inflation and harm the global economy. But there is a very interesting medium-term opportunity. And the question is, will the US be bold enough to seize it? And it's only got 9 months in which to do it, which is to reintegrate Venezuela this year into the Western Hemisphere, into the US hemisphere. Accept what happened. You may not like it, but accept what happened. Make Venezuela a US partner and take away in 5 years' time the Middle East as a source of conflagration, because Venezuela has more oil than all of them. And Venezuela is right on the doorstep. It has a better quality oil from what we need to consume. And the reason I say it's only got 9 months is because Florida is a Republican state now, and everyone in Florida cares about Venezuela, and they are angry about what the regime has done and the rest of it. Well, the party in power in the Senate and in the presidency is the Democratic Party. They don't care about Florida. They're not going to win Florida. They can say, screw you, Florida. We ain't going to win Florida. We don't care about how angry you might be. It's the only chance there is probably for the next 5 years, because one of the major institutions, whether it be the Senate or the presidency, will flip, I suspect, to bring Venezuela back in. If it doesn't, then I think the Middle East becomes a problem for the next decade as well. So there is now a 9-month window, I think, where you can open the door to removing the Middle East as a political and geopolitical, well, not political, as a geopolitical problem. Now, not in the short term, but in the medium term. So that's one optimistic perspective.
Yeah, that's a great point.
Yeah, I'm more optimistic than you are. I don't think there is any sort of deadline on that sort of a deal. I think it's doable by Republican or Democrat or independent.
The problem I have is, well, this comes into politics, is Florida. Florida will vote the opposite to whomever allows Venezuela back into the US sphere of influence. And the Republicans can only win the presidency and the Senate by keeping Florida. If they do the opposite, they might lose it the next time. Now, that's my concern.
Yeah, I believe the ballot harvesting and fake mail-in ballots are being done at such an advanced rate that you can win any state anytime. So I don't think either party is concerned about winning states anymore. Control P.
That's that the new keyboard key that's being introduced by Microsoft for its AI.
We were just talking during the break about AI and about our quirky predictions in the future, and I was thinking earlier I mentioned a sentient non-human intelligence that we have to confront, and I wasn't even talking about AI. So that's two sentient, maybe, I don't know, two non-human intelligences that we have to consider now all of a sudden, that they're being introduced into the public consciousness. I can go on for hours about the aliens and the pyramids, but let's turn to Adam about AI first.
I want to understand, are you worried about AI or are you optimistic about it?
Oh, I suppose it's a little bit of both, as the line between good and evil runs down the center of every human heart. So it's the technology, and it can be used for good or evil, and we'll see what happens. But just like we were all so excited about Napster and the internet, and now it's used as a tool of control and consensus and propaganda, the internet again, right? We thought it would be distributed information. So AI, Jane, as I like to call her. Adam, you've been following this. You're clued in more than I am.
I've been building apps with the new AI tools and am blown away by the capabilities.
Amazing. I heard they give the AI engineering problems, and the AI spits out organic looking constructions that meet all the requirements, and it's just fascinating. Nothing a human would ever do. We would build in angles, where this is some sort of organic seashell-like creations. That's just one example. Go on, yes, and then the apps.
Yeah, I mean, and obviously it's been able to discover new antibiotics.
Yeah,
that would have taken us decades to discover in traditional ways. Other major drug pipeline areas for exploration. It's discovered brand new materials with fascinating and very useful properties. So I think there's an enormous amount of benefit to humankind that is coming down the pipe from implementing or introducing AI into a wide variety of fields. I also think it's going to be just enormously disruptive in the short and intermediate term to certainly white collar work. I was just noticing that Google very quietly laid off 30,000 employees. They announced that over the last few days. I'm not sure if you guys saw that. Explicitly being replaced by AI.
Amazing.
And, I was probably not surprised to see how Microsoft has chosen to roll out AI as a co-pilot for their Office suite and for Microsoft Windows. I've seen the way that GPT-4 can manipulate worksheets, write and edit complex documents, legal contracts, etc. I've myself built extremely comprehensive and complex legal contracts and investment policy statements, etc., with the help of GPT-4. But Microsoft, of course, decided that they They didn't want to roll out AI in ways that would allow the spreadsheets to actually do the work of a human, but rather just sort of made the life of a human using the spreadsheets a little bit easier, right? Why? Well, because Microsoft's revenue model is based on the number of bums in seats, right? The machines can do all of these things that humans are doing with their Office suite, but Microsoft doesn't earn any revenue from that. So we're going to see, humans being replaced slowly, but the competitive pressures to make that work are going to add up very quickly.
So the interesting thing that struck me, one of the interesting things, perhaps that I should say, that struck me from that, is the implication, which in many respects is quite disinflationary. Because if you've got a scenario where AI is going to be putting people out of work, the labour market pressures aren't going to exist. And so we could quite easily, in the medium term, sustain an economy whereby interest rates are 1%, 1.5%, inflation is, absent geopolitical stress, pretty much under control. What we will do is a different question, but the landscape in which we might be investing in 5 years, or sooner perhaps, but over 10 years at least, could well be a very passive one in the sense of the inflationary environment and what that means for bonds, whereby bonds will be pretty much not able to earn you very much at all.
Yeah, and well, I mean, you'll feel pretty darn good buying 10-year bonds or, TIPS today at 2% real yield for 10 years in a disinflationary environment, if we do go back to the kind of disinflationary or low inflation environment that we had over the kind of the last 20 years and certainly most of the last 40 years. I think what this really highlights is that the world going forward, we're used to sort of thinking of the world having a single distribution where there's, there's an inflationary tail and there's a deflationary tail, but the most likely outcome is something in the middle. And I think actually what we're looking at going forward, at least for the next couple of election cycles, is what we call a bimodal distribution. You kind of have two potential outcomes that are completely different from one another. A Trump victory versus a Biden victory represents completely different economic and political outcomes for not just the U.S., but for the world. A Biden victory means a continuation of what they've been trying to rebuild, which is this sort of New Deal concept, where you've got big government, you've got government guiding policy decisions and, introducing incentives and disincentives in the economy, continued deficits as long as we can see above average. A Trump victory represents strongman, authoritarian type governance, probably shrinking of the budget deficits, and a lot more gifts to the U.S. private sector. So it's a very different outcome, and I think we see that all over the world, not just in the U.S.
Emil, any closing comments from you? Are you going to talk about pyramids and aliens again?
Yes, in that there should be another, a trimodal distribution. There's still an unknown. What if neither of these two candidates make it to this finish line? Yeah. It's a very unsettled future.
Okay. Well, unsettled it is, and that was going to be one of my closing remarks, which is to warn everyone to keep their eyes and ears open, because often the things that matter the most are those which we have no knowledge of at today's point in time. And when we find out what those things are, be very nimble and thoughtful about it. So that's my closing remark. Otherwise, it remains for me to say thank you, Emil. Thank you, Adam, for joining. It's been a whirlwind of discourse and intellectual something or other. Thank you very much.
Thank you. It was fun.
With that, all it remains me to do is to say thank you to our listeners for tuning in, devoting some of your time to Money Sense, and please do rejoin us in 2 weeks' time.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
To keep our records up to date and to ensure seamless communication, the Cayman Islands Chamber of Commerce Pension Plan encourages you to review and update your beneficiaries and contact details, including your email and mailing addresses. You can update your contact information by logging into the member portal or by contacting us at 745-7630 or via email to admin@pensions.ky. Remember to act now to ensure we have the most current information for you. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.